Hey guys, welcome back to Reserved Investments on YouTube. So in this particular video, we're going to talk about fractional investing as it relates to the antiques and collectibles trade. Now before we go any further, we have to define fractional investing as it applies to the antiques trade. There's a lot of companies out there like Mythic Markets and Otis Investments who are going out to the secondary collectibles marketplace and they're buying a $60,000 comic book or a $100,000 Magic the Gathering card, or a $10,000 pair of vintage Nike Air Jordan sneakers, or a $250,000 piece of art. They're taking that item and they're locking it up in an LLC, limited liability company. They're then taking that asset and they're selling fractional shares of ownership in that particular item at a very low cost. So the average Timmy, the average Poindexter out there can pay $25, $50, or $100 and buy one share of ownership and say that he or she owns a Incredible Hulk 181 in CGC 9.8 condition. Now there's a lot of problems that I have with the way this type of alternate asset investing is set up. That's what I'm going to talk about in this particular video. There's also a lot of people that seem to incorrectly think that this is a new phenomenon. This is a new thing in regards to the antiques and collectibles trade. Well, I'm going to give you a little bit of an example here that shows that this has been happening for years in the greater trade as a whole. So if we go back, we take our DeLorean time machine, and we go back to the 1980s. Back in the 1980s, the coin collecting marketplace was in a massive speculative bubble due to the advent of third-party grading. Now, the coin marketplace back in the 1980s was much like what the graded video game marketplace, or the graded Magic the Gathering marketplace, or the graded Pokemon marketplace is like today. There were a lot of speculators, unsophisticated investors, and collectors all clamoring to get a piece of that particular marketplace because they thought it was going to be the next big thing. And to be fair, when we talk about speculative markets, everybody always thinks about Beanie Babies. What the average investor doesn't really usually think about, in my opinion, is that there's a lot of stable markets in the antiques and collectibles trade that have been under the guise of speculative bubbles that have prospered. It's just that the people buying into those markets at present time, when the speculative bubble was going on, they pretty much bought at the height of that particular market. So I've said this before, and I'll say it again in other videos. The risk to the average investor investing in some of these markets like graded video games or graded Magic the Gathering cards is not what happens if that market goes to zero. Chances are that market will never go to zero. But the problem is, if you come into these markets and you spend $10,000 on a graded video game, and that graded video game goes down to $5,000 and sits there for 10 to 20 years, guess what? You just lost your proverbial ass and you probably don't even realize it. That's the threat, the real threat of investing in speculative markets. Well, back in the 1980s, the coin market was going crazy thanks to NGC and PCGS finally creating a third-party standardization of grading coins. Well, Wall Street was sitting by the sidelines going, you know, all these Timmys, Poindexters, and other people are coming into this market and they're investing in rare coins. They're investing in all these graded items. That's taking money away from us. You see, if they're investing in collectibles or antiques, they're not investing in assets like mutual funds, stocks, bonds that we get commissions from. So what Merrill Lynch set out to do was, Merrill Lynch was the pioneer, and they said, you know what we're going to do? We're going to get involved in the antiques and collectibles trade. We're going to enter the rare coin marketplace, and we're going to enter the marketplace for antiquities, and we're going to create the first mutual fund that allows investors to come in and buy up shares of assets in rare coins and other antiquities. And with this idea, the Athena Fund and its sister fund, the Athena Fund 2, was born. Now, if you guys want an interesting education, go to Google and simply type in Merrill Lynch Athena Fund and read all the wonderful articles that pop up in your Google search concerning how poorly and how badly mismanaged these funds were and how the funds went belly up within less than 10 years. Now, as you can imagine, a lot of the investors who invested in these funds were very upset as to how Merrill Lynch marketed these funds and also how they handled the client's investments. So when these funds went belly up, because as you should be aware, if you're buying assets like rare coins and you're linking those assets to a greater investment pool of money, meaning investors are giving you money to buy these assets, at some point you're going to have to sell those assets at a higher price than what you paid for them so that your investors can share into those profits and actually make an illiquid investment liquid. Well, ironically, since Merrill Lynch was buying into the market at the height of a speculative bubble, when they went to sell their holdings, the market had fallen, and they were taking substantial losses on these rare coins and other antiquities at the time. So Merrill Lynch, to avoid any wrongdoing, to ensure that they were still on the good side of some of their investors, they decided to pay back all 3,500 investors in full and just take a loss on the greater antiques and collectibles trade through the Athena Fund and the Athena Fund 2. It's still an interesting read. If you do have time to Google it, please do. Some of the articles are well worth reading that talk about the demise of the Merrill Lynch Athena funds. Now, what does this have to do with fractional investing in present day? Well, over the last 20 years, what the average person probably doesn't understand or know is that there have been a lot of pop-up companies that have tried to come into the antiques and collectibles trade and do some form of fractional asset investing in regards to rare or thought to be rare antiques and collectibles. A lot of these companies were very prominent during the dot-com rise even. And even after that, before the financial crisis, there was a run-up on some of these companies that catered to this market. Now, to be fair, I have no reason to believe that Mythic Markets and or Otis Investments is not acting in the full fiduciary responsibility of their shareholders and the people that are putting money in these markets. However, if I'm going to be asked if this type of asset investing is for me, the answer is no. And what I'm going to outline next in this video is the reasons why. So the first thing we're going to talk about is liquidity. Now, when we talk about financial assets, stocks, bonds, mutual funds, ETFs, if you have 100 shares of AT&T stock in your investment portfolio through Vanguard or Charles Schwab or Fidelity or what have you, you want to sell those shares, you simply log on to the website, you click the sell button, and within 24 to 48 hours, that money is placed into your account. It is extremely liquid. But when it comes to the antiques and collectibles trade, whatever you're buying, I don't care whether we're talking coins, currency, art, historical documents, first edition books, or we're talking about antique furniture, graded coins, graded comic books, vintage comic books, and the like. Any alternative asset like that is an illiquid asset, meaning you can't just click a button and sell it immediately and get your cash out of it if you want to get the best price possible. Yes, it's true. If you paid $50 for an item, it's now worth $1,000, and you choose to sell it for $500, chances are you're going to be able to sell it immediately with no complaints. But let's assume that you want to get the full market value for the items in your collection. It is not a liquid asset. It is an illiquid asset. There are transactional risks to sell that particular item for the full market price. Let me use this as an example. Let's say that you have a graded stadium events video game in 8.0 condition that's graded by Wada Games. And you want to sell that on the secondary market. So you list it on eBay and you sell it for $15,000 or $20,000, whatever the market is at present day, for a loose graded copy of stadium events. Somebody comes to you and they make a strong offer. You accept the offer. You send them the item. You get the money. Well, they get the item and they claim it's not as described, or they want to refund the item. eBay or PayPal is going to take their side in that dispute. They're going to send you the item back and you're going to have to pay them that money back. That is an example of a transactional risk as related to illiquid assets in the antiques and collectibles trade. Now let's compare that to our example that we just used in regards to selling 100 shares of AT&T stock. Once you click the sell button, that transaction's complete. You are guaranteed to get that money deposited in your brokerage account with no questions asked. Wall Street is known for liquidity. That's one of the benefits of investing in financial assets through a brokerage house and or through any type of financial vehicle like a mutual fund, stock, bond, or ETF. Now, going back to this example, when we look at an antique or collectible, it can be any type of antique or collectible that you want to imagine in your head. That item is a liquid, as we already established. Well, the problem that I have through fractional asset investing is you are taking liquid money, you are putting it in an illiquid asset, and then you are surrounding it with another layer of illiquidity. Now, what do I mean by that? Well, since you are not taking direct ownership of that item that you are investing in because you only own a fractional share or a fractional portion of that item, you are incurring more risk than you need to in order to invest in alternate assets like antiques and collectibles. This is why a lot of these companies like Otis Investments, Mythic Markets, and the like, they pretty much get the attention of the Timmys and the Poindexters out there who want to play in the greater antiques and collectibles pool but don't have the means to do so. So they buy fractional ownership in some of these items because the barrier and cost to entry is quite low. As I said, you can buy fractional shares of some of these items for as low as $25, $50 to $100. That makes it quite appealing to the people out there that don't have thousands of dollars to devote to one type of antique or collectible overall. Another thing you have to understand when you invest in these markets, there is no control of the asset in question. I've said this before. One of the benefits of owning and diversifying assets in the antiques and collectibles trade is you have access to an asset that you have full control over. You can sell that item at any time you wish if you plan properly. You can do what you want with that item. If you don't have control over the illiquid asset that you're buying, what is the point of ownership? It makes no sense to invest in these companies, in my opinion. Another thing that we need to talk about is the cost of commissions. Otis Investments, if you look on their website, they claim that in the future, they're going to offer a quote-unquote exchange where people can buy and sell shares of these assets. Well, here's the problem that I have. How are they valuing the asset in question to price the cost of those shares? Are they valuing the asset at what they paid for it, at $60,000, to use the example of the Incredible Hulk 181 comic book rated by CGC in 9.8 condition, or are they using current market value? If they're using current market value, the price of that asset is going to float. Another thing that you also have to be realistic on is that there may be commissions if you go to buy and sell shares on that exchange that they set up. This is not commented on anywhere on their website at present time, whether or not if you buy shares on that exchange or sell shares, if or not there's going to be a commission levied at that time of purchase and or sale. The final thing when we look at this, you have to also take into account the stability of these companies. Now, I have never seen their asset sheets. I have never seen their financial records. So I don't know how secure they are in regards to buying these assets and holding them for the long or short term. One of the problems that I have on their website is they state that if they get an offer to sell, they're going to put it up to vote for all the people that are invested in that particular holding. Well, my problem with that is markets move rather quickly in the financial realm and also in the antiques and collectibles realm. If somebody's interested in that item and they want to make an offer, they're going to want to buy that item as soon as possible. They're not going to want to take the time to have everybody who owns a fractional share in that item vote on whether or not they should or should not sell it. So these are my reasoning for avoiding companies like this at present time. Now, is it possible that Otis Investments or Mythic Markets could come out of the gate and really revolutionize this side of fractional investing in the antiques and collectibles trade to the point where I change my mind? If that's the case, yes. And I'll either do an upcoming video on that or I'll write an article for Antiques and Auction News and expand on these concepts further. But for the record, the average person out there who is thinking of investing in the antiques and collectibles trade would be better off buying items of a high-grade caliber that they can afford to buy in full and take full ownership of, rather than going through companies like this. I will do a follow-up video on this. If you guys have any additional questions, if you guys want me to break down both websites for you, I will gladly do a total Q&A session where I break down all the commentary on their websites under the FAQ sections and tell you my thoughts as to how their rules, terms, and regulations benefit or do not benefit the average collector, speculator, and investor out there. So I thank you for watching. I hope this video has been helpful. I value your feedback. If any of the content that I produce has been of use to you, please consider subscribing to this channel. Thanks, guys. And this video will probably premiere in 2019 still. So this will be my last video I'm going to do in the year 2019. So most of my other content will be released in 2020. That being the case, I wish you all a happy and safe new year. Thank you for subscribing. Thanks for watching. Wish you all the best.